Welcome everybody. This is Patrick Zielbauer from Infinity Futures. Thank you for coming to the event today. It is 3:30 p.m., June 7th, Thursday. Thanks everybody for coming. So let's do some risk stuff real quick, and then we'll get right into it. All right, trading futures, options on futures, and retail off-exchange foreign currency transactions involve substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. So folks, just be very cautious about depositing only risk capital into a futures account. If you have any questions about what that means, or if this type of trading is appropriate for you, please feel free to have a discussion with your rep in our office. Everybody here has one, whether you're a client or not. We speak very objectively when it comes to risk, and we'd be happy to discuss it with you. All right. This event, titled Bond Trading Bootcamp, here with Jonathan Rose, customer of Infinity. Jonathan and I were connected probably, I'm guessing, it's definitely been over a year. And we wanted to bring Jonathan on board because of two reasons. Number one, he has a style of trading that jives really well with some of the things that Infinity does best, and we'll talk about that a little bit as we go. But the other two parts of part B here are, we had a lot of interest in interest rate trading. We've been doing a lot more bond trading. I think that the conversation about interest rates, especially right now, being in the news all the time, is bringing these products to the forefront. So a lot more of our clients are asking us for ways that they can get involved in the bond and the note markets, and that again jives really well with what Jonathan is doing. But also a lot of our clients who had been sort of, I don't know if chewed up is the right word, but some people feel like they've been chopped up a little bit, trading a little bit too actively, maybe over trading their accounts. They're looking for ways to participate that don't involve a stochastic MACD crossover on a 1-minute chart, and so Infinity, as a brokerage company, we need to keep people around. We need to keep people interested, but we need to keep people around. And one thing I have noticed with some of my folks who have made the transition from trading in traditional day trading environments into the type of trading that Jonathan teaches people how to do, is it definitely slows them down. And they usually take far less trades, and some people might wonder why a brokerage company would encourage people to trade a method that involves them trading a lot less. But they tend to be here for the long haul. That's something we've seen a lot of over the last year or so, since we've been getting people on board who have either made the transition from trading in other traditional day trading methods, or people who Jonathan has introduced to us. So there's been some staying power that has been impressive to me as someone who's been watching people come and go for the last 14 years that I've been working at this company. So we believe there's something here. We believe that Jonathan explains a relatively complicated topic, in my opinion at least, like the yield curve, in a way that is easy for people to understand. If I can understand it, I believe anybody in this room can understand it. So that is the reason why we have him here today. So Jonathan, I want to thank you for taking the time out of your day to do this presentation. Definitely a valued partner of Infinity, and we hope you perk some ears here as a result of this presentation. And folks, if you have questions along the way, I'll kind of be hanging out in the background answering things. Feel free to type some questions in, and we'll definitely be doing some Q&A throughout. So thanks again, everybody, for coming, and Jonathan, thanks for your time.
Patrick, thank you very much. Can you guys hear me okay? Patrick, I got to take over the screen.
Yeah, your audio is great. And okay, good. You're good to go.
Awesome. Wow, that was a really sweet introduction, Patrick. Thank you very much. I really appreciate that. So Patrick and I have been working together for a while, and I've gone into the office. I'm located in Chicago as well, and I have a lot of similar background to a lot of the guys over at Infinity. And it's been very synergistic. And this style of trading that I'm going to introduce you to, I noticed I have some clients on here as well, which is great. But this style of trading, for those who haven't been on one of my presentations, it's going to feel and very different than what you're used to. But the same way when Patrick was talking about the 1 minute stochastics crossing over the MACDs, that's very foreign to me. So the same way this might be a little bit different to you. A lot of the strategies that I've seen some of my clients use in the past is extremely different to me. So it's kind of like the same way. There I am in Chicago. Moved to Chicago in 1997, grew up in New Jersey, moved to Chicago just to trade. Been trading my entire career. So today, I'm going to just walk you through a unique approach to trading bond futures without speculating or hoping or crossing our fingers that the market moves in our favor. Who is this for? I kind of think it's for everybody. Everybody who's trading futures. Let me ask you right now. Right now we got about 60 people on here, guys. If you could just let me know in the chat who here trades bonds right now. What and if you do, kind of just let me know, maybe ZF, ZN, or ZB, which bonds you trade or no, just so I have an idea, because when I get into the educational part, it'll really help knowing what kind of experience is on here now. ZB, UB, a couple of no's. Okay. Lots of ZBs, a couple that don't trade. Cool. Okay, fantastic. Very, very helpful. This is a real trade. So I would like to say, for those who are trading for a living or maybe trading full-time in retirement, I think you'll get a lot out of this. If you risk money that's important to you, and maybe if you're just confused or frustrated or just looking for a change. Some people, you get so frustrated going back and forth, just speculating on, say, S&P futures, hoping that the market goes in your direction. Sometimes taking a step back and seeing a different way of approaching the market is what people are looking for. I'm going to show you the exact correct way that not only that I think how futures should be traded, how bond futures should be traded, but if you go to the Chicago Mercantile site and look up interest rates and start reading their white papers on interest rates, they're going to talk about valuing the yield curve, trading the entire yield curve. Big promise, everything I teach you, I've learned through the hard knocks of the Chicago trading pits. I'm going to break down this proven approach step by step so you can use it to build your trading foundation. And when we're done here, I think you'll see how it's absolutely possible. A lot of people I know on webinars will come and say trading is so easy. You can learn in 3 days, be a trillionaire. I'm going to take the exact opposite. Trading needs to be learned. Just like your profession, I'm not going to come and add value to your profession in 3 days, in 2 weeks. It takes time. If you're an accountant and I'm going to come work for you, probably need 6 months, 9 months, 18 months to add value. I think trading is pretty much the same thing. Guys are saying the screen's really tiny. Interesting. Guys, are you having trouble seeing the screens? Let me check my audience. Oh, that's why, guys. How about that? Is that better? Sorry about that, guys. I have multiple screens here. Well, you guys are all so sweet and kind, because it took about 3 screens before somebody said, would you mind making your screens just a little bit bigger? All right, sorry about that. So again, I think you'll see it's gonna be a little bit different though. It needs to be learned. But like anything that needs to be learned, once you put your time in, I think you'll find that the benefit is great on the other side. But if there's any kind of strategy that doesn't need to be learned, or you can just quickly put up an indicator and it's going to give you all the answers for the test, that probably shouldn't pass the sniff test with you. Again, it takes hard work. You must be open and committed, okay? It's different. This needs to be learned. And also, trading involves risk, whether you're trading outright, whether you're trading spreads. okay? Just because you're trading spreads, it doesn't mean it's less risky than outrights. And Patrick and I talk about this at length because spreads, as Patrick likes to say, it's a double-edged sword where you're getting, it's a little bit, you can really take your margin down, but you're also adding leverage as you take your margin down. So what I always suggest for any trader, paper trade. Paper trade. The exercise that I do with my coaching clients is I want my guys to do trade on paper, make $300 in a week. If you can't make $300 in a week on paper, the next week try to make $300. Keep going through that exercise until you accomplish that goal. Then try to make $800 on paper. Earn the right to trade real money. Trade real money, try to make $300 of real money. Keep earning the right to move forward. By doing that, for one, it's going to make you keep your head up for the longer term. And for those who say, I don't like to trade on paper, I can't trade on paper, I need skin in the game, well, earn the right. Have that discipline. Make sure that you practice, make all the silly mistakes that aren't going to cost you real money. So when you finally learn, whether it's 3 months or 6 months or even longer, your account has whittled down by all the silly mistakes. So be patient, have respect for the markets. Really appreciate everyone coming out. Again, this is probably, I don't know, my 7th, 8th, 9th time presenting with Infinity Futures. The reason for why Infinity Futures makes so much sense is Infinity Futures has what's called exchange guaranteed margin. Most other platforms aren't going to offer exchange guaranteed margin. So for instance, one of the trades that we do, it's called the BUB. It's the 30-year contract against the Ultra contract. So a BUB trade, you buy one and you sell the other. I'll explain that in detail, but if you did that trade on Thinkorswim, that's going to cost about $10,000 in margin. $5,000 for a one lot estimate for a ZB, $5,000 for a UB, $10,000. But if you do that trade on Infinity Futures, they're going to use the exchange guaranteed margin for that spread, and that margin is going to be about $1,500 or $2,000. That's a serious difference from most other platforms like a Thinkorswim or like many others. Most retail traders don't realize that, but for that very reason is why when I talk about futures, the only broker that I present on is Infinity Futures. And the only broker that when people call me and say, oh, I'm trading bonds, I entered your bond program, where should I go trade? Go trade on Infinity Futures. It makes so much sense. And so that's why we have this great relationship, because it really is synergistic with this trade, makes a ton of sense for my clientele. Patrick, could you hit Sam for his question? Sam, that's gonna be a Patrick question. A little more formal background, guys. Again, I told you I moved to Chicago in '97. That's when I graduated from college. I started out from '97 to '03 on the floor of the Chicago Mercantile Exchange trading NASDAQ futures and trading S&P futures. The way that I would trade those is I would trade on a computer that surrounded the pit. I had a friend who was in the pit, and instead of guessing whether the NASDAQ futures would go up or would they go down, I traded an arbitrage between the pit and between the computer. I traded the difference. That's when I got exposed to relative value trading or relationship trading or pair trading. Some people call it delta neutral trading, which it's not really delta neutral trading, but still some people call it that. I don't want to guess whether the NASDAQ's going up or the NASDAQ's going down. I'm going to look at it relative to something else. In 2003, that was when the NASDAQ sold off big time, hit its low, and that's when volatility really dropped out of the market, and I was looking for a change. At that time, I was recruited to a new firm that was trading bonds. I didn't really know how to trade bonds before that. All my experience was in NASDAQ and S&P futures. I joined that firm in 2003. There were 6 traders there at the time. In 2010, we sold that firm to a major hedge fund. At that time, there was 200 employees, over 100 traders. And there were 4 directors. I was the director of trading. There was also director of technology, director of operations, and a general partner. But my job was to train the traders and also to manage the entire firm's position. Because a proprietary firm works that all the traders are trading firm capital, but the firm needs to manage the entire position. So that was my role with that firm. In 2011, I took a year off. I was under a non-compete. For some reason, they paid me not to work. And that's when I was able to fulfill my dream of doing an Ironman triathlon. Super excited to do that. And then I was an options market maker for the next 4 years. That's a little background. I figured I was in Chicago. I'd eventually move back to New York, but met my beautiful wife, had 2 kids. Now I'm staying in Chicago, I think forever. End of 2015, I started Active Day Trader. I started Active Day Trader because I was messing around on YouTube, watching some trading videos, watching some videos on bond futures, and I couldn't believe the nonsense that I was hearing. I just thought it was straight BS. So for me, I thought there was just a major void in the market for what I consider to be real education. Started Active Day Trader at the end of 2015, and it's been a blast. All the trades that I teach, I want them to be logical. I want you to take a step back. I want you to feel like, wow, this trade makes sense, like common sense. Okay? Again, we're not just guessing on direction. So this bond futures trade, I've taught for a long time. And these are like the 3 secrets, the 3 things that I think are really important in learning this trade. For one, bonds are a puzzle. Once you learn how to put that puzzle together, it'll make a lot more sense. 2, you always need to be in the right bond. You want to sell what's expensive. You want to buy what's inexpensive. I'll show you some examples on how to find that. 3, once learned, this is potentially, in my opinion, a very consistent approach to the markets. So let's jump into the educational portion. Interest rates and bond prices, they move in opposite directions. Okay? Why they move in opposite directions? Let me explain. Let's say that I buy a 30-year bond. I invest $1,000, and for 30 years I get 3%. Okay? Great return. Just kidding. It's not really a great return, but I get $30 a year for 30 years. At the end, I get my $1,000. Now, if the 30-year rate all of a sudden goes to 10%, just in like a silly example, it all of a sudden goes to 10%, I'm stuck with this 3% bond. How am I ever going to get rid of the darn thing? I want the one that yields 10%. I'm stuck with the one that yields 3%. The only way that I'm going to get rid of that is the price is going to get killed. The price is going to go down to like $100. So maybe I sell it to somebody else. It's $100. They get the 3%, but it matures at $1,000. So that's where they're picking up that extra yield. And for that reason is why interest rates and bond prices move in the opposite direction. Now we want to put together the bond puzzle. Before I do that, I want to talk about relative value trading. Now, relative value trading is a term that I've been using since I started Active Day Trader. Before starting Active Day Trader, I didn't have to call it relative value trading. I could just call it trading because it's the only thing that I know. Relative value trading is valuing one thing against something else. I believe that every single thing that we do in our lives, we do using relative value. When we buy a phone based upon other phones that are similarly priced with different features. We're valuing that phone and making a decision using relative value. When we buy a car, we're going to find, 3 to 5 cars within a certain price that has the certain features that we want, and then we're going to compare them against one another, right? You're never just going to go buy one car, look at one car and say that's exactly what I want without valuing it against other cars in the class. When you buy a house, if you're going to buy something in New York, you're not going to value it against something in Chicago. You're going to value it against other comps in the area. But yet, when people trade, they're just trading the S&Ps all on its own. They're buying it, they're selling it, they're buying it, they're selling it. They're not valuing it against anything. That makes absolutely no sense to me. So this kind of trading, retail traders like to call it relative value trading or pair trading. It's just trading to me. It's the only way we look at the markets. So let's talk bonds. But instead of talking bonds, I'm going to do a silly example using diamonds, because I want to take a step away from bonds because people get intimidated by bonds. I don't know anything about diamonds, by the way, as you'll see soon. Right now, let's all of us together, let's say we're all going to a flea market. It's a one-day flea market. In that flea market, they trade 4 things. All they do is trade diamonds, and they trade 4 kinds of diamonds. They trade the 1 carat, there's 2 carat diamonds, there's 3 carat diamonds, and there's 4 carat diamonds. When we walk in the flea market all together, these are the prices. These are the kind of mean prices from all the vendors. 5 hours of walking around and trading at this diamond flea market, the prices move. And here's how the prices move. The 1 carat, not a lot of demand. It's still trading for $1,000. Same price as when we walked in. The 2 carat, it's up a little bit. It went from 2,000 when we walked in. Now it's trading 3,000. The 3 carat hasn't moved at all. It's still at 4,000, but the 4 carat is now trading at 9,000. If we looked at things from a relative value standpoint, we might decide that, you know what, the 4 carat is expensive, but it's only expensive relative to the 3 carat. So I don't know, maybe if we owned a whole bunch of 4 carats, we might sell those and invest in 3 carats. I think it's safe to say that the 3 carat shouldn't be valued more than the 4 carat, right? Is that a fair assumption? But it's a free market. So if somebody has to buy all the 3 carats there and they're not buying the 4 carats, those 3 carats can very well trade for a higher price than the 4 carats. It's just pure supply and demand. But instead of looking at diamonds, what we want to look at is bonds. We want to look at the yield curve, and we want to look at the liquid contracts that are traded through the Merc. That's the ZT, the 2-year, the ZF, the 5-year, the ZN is the 10-year, the ZB is the 30-year, and the UB is the Ultra Bond. Okay? But instead of just looking on whether the ZB is going to go up or whether it's going to go down, as you could probably guess, I want to look at the relationship. I want to look how the ZB is priced relative to the ZN. How's the ZB priced relative to the UB, rather than just guessing. So if we look at it from this perspective, and let's say a big, massive trader gets a margin call. Patrick calls somebody and says, you know what? You got to get out of your position. You've run out of money. So what they do is they have to sell their million 5-year future contracts that they were holding. 5-year future contract's going to go down, right? That doesn't mean the 10-year is going to go down. That doesn't mean the 2-year is going to go down. Somebody just got forced out of a position. Or let's say a government has to sell millions of 5-year future contracts. It's going to get cheap, but it's going to get cheap relative to the other instruments on the yield curve. So in this example, we traders would want to buy the ZF. You could buy the ZF and possibly sell the ZN. Maybe you buy the ZF and you sell the ZN and sell the ZT. That would put on a trade which is called a butterfly. Option traders out there, just like an options butterfly. They call it a butterfly because the ZF would be the belly and the 2 would be the wings. So you buy one and you can sell the others. But you can see too, if I go back to that earlier example when we talked about margin, if we're doing a trade like that, you can't do a trade like that on a thinkorswim platform. It wouldn't make any sense from a margin perspective. You would need a firm that specializes in futures. Again, that's exactly why I'm talking to Patrick. That's exactly why I'm sending all my clients over to Infinity Futures, because this trade only makes sense with a firm that specializes in futures. Now, the Chicago Mercantile Exchange calls all these different relationships these funny names. So the ZT against the ZF, it's called the tough. The ZF against the ZN, it's called the fight. The ZN against the ZB, it's the knob. The ZB against the UB is called the bub. So the knob, ZN against ZB, it's called the knob because 10-year notes over bonds. Knob. It's also called notes over bonds. ZF, 5-year against 10-year, is called the fight, right? Got my things flying all over. This is directly from the Chicago Mercantile Exchange. This is actually an outdated one. Let me get you a newer one, and I'll put it in the chat just so you guys can have this. And what I want to show you is this trade, it's not something that we make up. There we go. So if I just search ICS, intercommodity spreads, and then you can click on the first thing that comes up. We're going to be in September. And then I'll throw this in the chat for you guys if you want it. And so these are the ratios and the spreads given to us from the Chicago Mercantile Exchange. And they give these spreads to traders because, again, this is how the trade was intended to be traded. This is how professionals look at this trade. The knob here is 10-year against bonds. The bub is the 30-year bond against the ultra bond. And they got all these silly names. Okay. Let's get you out of here. Now, the trade works like this. I'm going to go through a little bit more education on this than I usually do with these presentations. 2s, 5s is the yellow. 5s, 10s is the blue. The tough and the fight. Tough plus the fight equals the tut. You guys see that? So the tut here is 2s, 10s, but 2s, 10s is made up of 2s, 5s and 5s, 10s. So if we know the value of the tut, we can back into the value of the two pieces to the entire puzzle. And I think it'll be a little bit more clear if I go through this and explain it this way. I'm going to try not to confuse the heck out of you, but I really want you to see what's possible. And I want you to see the difference in approach, because I know a lot of people are just speculating on futures. And for me, it just doesn't make sense. This is just, from what I found, a more conservative approach. Again, that's my opinion. So if we look here, the ZT is the 2-year, ZF is going to be the 5-year, ZN is 10-year, ZB is the 30-year, UB is the ultra. But if you look under the hood of exactly what they are, the ZT is a 2-year, the ZF, it's a 5-year future, but what it really is, it's a 4-year. It's a basket of 4-year bonds. The ZN, it's not really a 10-year, it's a basket of 7-year. And so I just want to show you that, because I know a lot of people make some claims on webinars without really showing the information. So again, I want you to see. So again, if I go to the Mercantile Exchange site and I look up the 10-year, which is right here, ZN, and we scroll down, grade and quality, U.S. Treasury notes with a remaining term to maturity of at least 6.5 years, but not more than 10 years. So what you're going to find is the average yield, or the average, it's called duration, of the notes in the 10-year future is actually closer to a 7-year than it is a 10-year. Okay, so that's why I put 2, 4, 7, 8, 30. Now, what I want to concentrate right now for this little lesson is let's just look at this back end of the yield curve, which is going to be 10s, 10-year, 30-year, and the UB. The knob is 10s and 30s. Give you a little color coding. And then the ZB, UB, let's do that here. So the ZN and ZB is the knob. The ZB and the UB is the bub. The knoll are both of these put together. Okay? So if we follow the knob and we follow the bub, the two of these together equals the bottom one, the knoll. If we look at it as diamonds, this would be, you know, the 2-carat diamond, the 3-carat diamond, and this would be the 3-carat diamond and the 4-carat diamond. And then this spread would be the difference between 2 carats and 4 carats. If we know the difference between 2-carat diamonds and 4-carat diamonds, we have to end, if the difference between 2 carats and 4 carats is 3, okay? Let's say the difference between 2-carat diamonds and 4-carat diamonds is 3. If the difference between 3s and 2s is 2, what's the difference between 3s and 4s? So if this one equals, what did I say, 4? This one equals 3. What does this have to equal? It has to. This is participation time. So if the difference between the 2-year, the 4-carat and the 2-carat, if the difference is 4, the difference between 3s and 2s is 3, it has to be 1. Yeah, it has to be, right? There's no other way. It's impossible for it to be anything else. Yeah, it has to be. Right, you guys got it. So the same thing, let's do this. Let me just take these off. If this ZN goes like that, and this goes here, does this spread need to be higher or lower? Where do you think this spread fits in? Would it be down here? Would it be lower than this, or would it be higher? Yeah, it has to be, right? Because we know that this plus this equals this. What about if this thing goes like this? Rallies like crazy. Whee, all the way up here. This doesn't really rally. It comes up a little bit. Where does this thing go? It's got to go way up here because we know this plus this equals this. Okay? But instead of me doing on Excel, we would look at it this way. And Patrick and I work really close together where I share all these charts with him so we can set this up in Sierra, which comes with Infinity, which is super, super convenient. Because what's here on top is the 10-year against the 30-year, and what's down here is the 30-year against the Ultra. So if I line them up, 529, right like that, so they're in the same dates, you can see here the knob was very expensive relative to the bub. And those are the trades that we're looking for. And I always get this question, Jonathan, what's the return we could expect if we do this trade? And I can't answer any questions about returns. Everybody's different. If I take my kid to go learn how to shoot foul shots and he works on it for an hour and learns how to shoot foul shots, I can't ask the guy, hey, what's my kid's foul shooting percentage going to be next year? Who knows? Is he going to practice? Is he going to learn? Right? There's so many variables. But what we can do is we can definitively see when they break down in value. And then it comes down to the most important thing in trading, which is learning how to manage money, learning how to ladder in and out of trades. That takes time. So let me stop and ask a question here, guys. As I go through this presentation, I always get a lot of different reactions. And the first reaction would be, kind of, wow, this is so different. I'm really curious. I really want to learn this. So let's call that one. Two is kind of cool, kind of confusing. I'm not really sure what to think. And then the third reaction is something like this. Totally overwhelmed. Jonathan, what the heck are you possibly talking about? So what do you guys think right now as far as kind of like a 1, 2, or 3? Oh no, those are too many 3s. Lots of 3s, a couple of 2s. Hey, Dana, we got a 1. Yeah, no, Richard, I get it. So we get a lot of these too. This is over my head. Stu, great question. What's the logic behind? So the logic behind this is going to be when they break down. And so if I go back to this chart and show you this, here's the logic. When the relationships break down is when we want to get into a trade. So when this happens right here and the 5-year future contract moves and gets very inexpensive relative to the other ones, think of the other contracts don't move at all. But all of a sudden, again, someone gets a monstrous margin call, has to sell all their 5-year future contracts at the market, and the 5-year future contract goes down. The 5-year future contract is going to be inexpensive relative to the rest of the yield curve in this specific example. And those are the opportunities that we're looking at. So rather than guess whether something goes up or whether something goes down, we want to look at the relationship. We want to trade the difference between the 5-year and the 10-year, the difference between the 10-year and the bond, the difference between the bonds and the UB. So the question is, how often do these margins calls occur? The margin calls are just a phony baloney example so you can see how value is created. I have to teach you how to figure out exactly what's cheap and exactly what's expensive. You could do this trade as a spread trade, as a relationship trade, where you're doing one against the other, or if you just want to trade outrights and just trade one bond at a time, if you just trade ZB, well, if you want to buy ZB because you think yields are going lower and the ZB is going higher, in this example, I would say, hey, I love the idea of buying ZB, but have you considered buying the ZF? Because the ZF is inexpensive relative to the others for this reason. Okay? Sam, sure, I'll put those 2 charts up again. Just got to find the darn things. And again, this is just one example. This is just the knob, the ZN and ZB against the ZB and the UB. The whole point is that there really shouldn't be that big of a disconnect between the relationship between 7s and 18s and 18s to 30. In my opinion, it's not like they can move in just completely opposite directions, for forever. That just doesn't seem very, very probable to me. Okay? Yeah, the yields. The yields. Is the yield curve static? Yeah, the yield curve is moving around all the time, and that's what presents opportunity. The reason why this trade works well right now, again, my opinion, is because the Fed's moving. And right, the Fed is in play. Whenever you have something that's on the front page of the newspapers, and right now the yield curve, because it's been flattening so much, it's on the front page of the yield curve, right? Haven't you guys been hearing that the yield curve is flattening? The odd thing that's going on is the yield curve is flattening so much, but the stock market is rallying so strong. But in years past, in the history of the market, the yield curve has been the first signs of a recession. So what I think will happen is either the yield curve needs to steepen. By steepening, that means that the difference in yields needs to get further and further apart, or if the yields continue to get closer and closer together and maybe that yield curve goes inverted, I don't see how the stock market continues to rally. So what I teach is everything's tied together. We don't want to trade bonds without following the equity markets, without following gold, without following oil. Everything is tied together. So we want to look at the yield curve to give us good information on what the equities are doing, what oil is doing, what's gold's doing. Taking a step back and looking at everything. Lee, this can be charted on TOS or Sierra. You don't want to trade it on TOS, that's for sure, because the margin won't pretty much, it makes 0 sense not to trade it with a firm that specializes in exchange guaranteed margin. I don't know of any other firm besides Infinity Futures. Coming from the professional side, I didn't even know that firms would allow people to trade futures without that guaranteed margin, because I think it's just taking advantage of people, in my opinion. Okay. So let me get into how the program works, because you can see, hopefully, there's a lot to absorb. This is something that takes some time. But again, I go back to that example of learning your profession. It's going to take some time. If something is so easy, if you're making a trade based upon a double bottom, a triple top, a head and shoulders, a triangle pattern, I ask you this: how long would it take for me to teach my 9-year-old what a double bottom is, what a triple top is, what a breakout is? Probably not too long, right? So if that's the case, is that really where we want to be investing our hard-earned money? I don't know about you, but the answer to that for me is no freaking way. It takes time. But again, we're in this for the long haul. Here's how the bond program works. Bond Bootcamp is a foundational course. I'm going to give you guys a ton of content because I really want you to understand the trade. It's broken up into 3 different levels. Level 1 is all about trading outrights, not trading spreads. Level 2 is going to be trading spreads. Level 3 gets into some more advanced yield curve analysis. I also include easy to read bond specs that includes margin, contract info, and then Patrick can get you whatever you need for Infinity Futures. So Bond Trading Bootcamp, overall, I don't know what the entire value is because I really don't know anybody else who's teaching this. But what you'll also get, in addition to the 3-hour Bond Bootcamp, is you're going to get an 1.5-hour training on how to get the math, which is simple, straightforward. It's just a matter of showing you exactly what products that we want to trade. And this 90-minute presentation shows you all about how to make the charts and how to make what we call butterflies in the different spreads. So overall, you get the Bond Trading Bootcamp, and you also get the 90-minute presentation on butterfly construction. Also going to include lots of good bonuses. The first bonus is a PDF. I call it Fed Dominator, because what I did is I looked back when the Fed moved between 2003 and 2011. And every time they changed interest rates, I made a PDF to show exactly where every single bond was trading along the yield curve. So now that the Fed is moving, you can go back and look, oh, the last time they put Fed funds rates at 2.25, this is where all those instruments were trading. When they move it to 2.75, you can see exactly where they were trading the last time. So you get these 3 different things. It's 4.5 hours and that 10-page Fed Dominator. What's new and what my clients ask for, because some people don't want to learn just on video, they want to learn on a PDF, is there's a 25-page PDF that outlines the entire trade. The 25-page PDF is going to have little quizzes in there. It's going to walk you through every aspect of this trade. And so people have really liked this in addition to the videos. I always like to say, you got two choices now. Take a shot, learn something different, commit to education. The other choice, do nothing, continue doing what you're doing. No harm, no foul. But for those who want to join, it's a one-time payment. It's $297. You get pretty much 5 hours of education. You get 2 PDFs. The second PDF is a 25-page PDF that really breaks down every single aspect of the trade. And for anyone on the fence, I want to throw this out there as well. This is being recorded. Obviously, Patrick's on here. Whoever moves forward with this, there is a 30-day money-back guarantee, no questions asked whatsoever. So if you move forward with this and then you watch all the content and you still feel like that woman with the fire hose, send an email, support@ActiveDayTrader, return it, no problem. I appreciate you making the effort and moving forward. So you get a 30-day guarantee. I'm here to help. Patrick and I are very similar, that we're both extremely quick replies over email. So for anybody who's interested, I'll throw this in the chat. It's activedaytrader.com/Fed. Come learn the trade. The way the bond program works is this is the first level of the bond trade. After this, there's an advanced bonds that has a private Facebook group along with a live class once per month. That class, you need to take Bond Bootcamp first. Make sure that you like the trade. Make sure that you're really going to participate in the trade. For those people, after that, we can talk about advanced bonds. That's by application only, because I want everybody to go through the first level, make sure that they have that foundation first. That's what I got for you. Happy to open it up for any questions. Any questions about margin, I'll probably have Patrick jump on and answer those. Any questions about the trade? I'm your guy. So Dana, good question. So Dana's question is, other than the butterflies, it sounds like this is just a pairs trade. So what you're doing is valuing the yield curve. We're looking at the shape of the yield curve from 2s out to 30s, and we're looking at all the relationships in between. So Dana, it is a pair trade, but if you think about it, the really, really fun part of this trade is watching the difference between 5s and 30s. If that's steepening, which is rallying, then we want to look at the individual parts that make up that spread. The other great benefit is it'll just help you understand what's cheap and what's expensive. So if you're trading outrights and you want to go long, you're not just blindly going long the ZB because you trade ZB. Maybe the ZN's inexpensive to the ZB, so therefore you definitively want to get long the ZN. If you want to get short, maybe you want to get short the ZN, the ZB, the UB. At least do an analysis so you can figure out what's relatively expensive, what's relatively inexpensive. So what I do is Patrick has all the spreads and the butterflies for Sierra charts. So those could just be easily just sent or downloaded to your system. Super easy to do. And then also anybody in the bond trading bootcamp, the math in order to figure out the exact ratios, I send out every quarter anyway. I want you to learn how to do it on your own because it's most important to learn how to fish, but I do it for you as well. Hey, Don, great question. So the TN is another point of the yield curve that is a newer product. The reason they came out with that is because the ZN is closer to a 7-year and the TN is a real 10-year. So yes, you could definitely add that into the trade. Patrick, is that available for Infinity now?
I think we should have that actually. There's a chance we actually have it tomorrow. In fact, we recently did a big infrastructure project on our side, and it sort of prevented us from adding new contracts for a little bit. But that project has been completed, and as far as I know, Transact, our FCM, has been testing it for the last 2 days. So I hope to know tomorrow, actually.
As long as there's liquidity, the TN is extremely synergistic with this trade. It's an absolute no-brainer to incorporate the TN as long as there's liquidity. So every point, so the great thing about the TN, the TN is when you're trading the yield curve, if you trade the difference between 2s and 30s, those two products don't have a very high correlation because they're so far apart, right? A 2-year all the way out to 30-year. But if you trade the difference between a 7-year and a 10-year, those are very, very highly correlated. There's a much closer relationship. So the great thing about the TN is now you'd be able to trade the 4-year, which is the 5-year, the 7-year, which is the ZN, the 10-year, which is the TN, the 18-year, which is the ZB. So they're adding more points along the yield curve. So that's just a great benefit. Mark's asking a great question. What's the average length of the trade? Don, no, my pleasure. So the average, I mean, that's such a tough question, Don, because if you're just doing outrights, it might be a good deal shorter. If you're doing spreads, if you're doing butterflies across the entire yield curve, it's a very difficult question to answer. So I would say the trades can be anywhere from an hour to longer term structural trades for those that are willing to stay in the trades. I would say as far as the advanced bond room, the average length of the trade, just off the top of my head, is about 3 days, 4 days, something like that. Okay. Lee, I don't understand. You just put 522 in there. I don't understand what you mean. Oh, Sammy, these things move. Sam is saying, does it vary that much on time frames? These things move. Yeah. It's kind of funny. There's this stigma about trading spreads that I don't want to trade spreads. They don't move a lot. My bond traders, you should say the same thing, and they move. What's most important in this trade and what takes the longest to really learn is entry, because it could sucker you into, it doesn't really move, and then when the best trades present, they can move. So you need to be disciplined. You need to wait for really good levels, and that's why it's so important to paper trade and learn. Every time throughout my career, whenever I work with a trader, the trader who takes the most amount of time before they put risk on to get in the market is going to do the best. In trading, without a doubt, the tortoise beats the hare every single time. Every single time. Okay. Oh, what happened during the move in May 22nd? So Lee, that was kind of tricky because that's when the contract roll was. So the contracts were rolling from June to Sep. So Don, the margin is going to be through Infinity. I think he's got a PDF for you. That's a good answer for everyone. Dana was just asking if Infinity has a paper trading account, and they do. So it's a great way just to do the exercise and do the practice. And also, David, thank you for sharing. I think Patrick will beat me up if I share that, though. I don't think I'm allowed to. Account minimum, Jim, I think with Infinity, the account minimum is $3,000. The minimum for this trade, again, tough question to answer. I know there are people trading it with 7,000 or 8,000 trading outrights. You know, to trade the spreads, you probably want to, be 12,000 or more estimate. Okay. And again, guys, if this is something that you want to try, 30-day money back guarantee. If you don't like the sound of my voice, you can return it. It's totally cool. What I want is be exposed to a different way of approaching the market. Best case for me is if you're trading and you're frustrated and maybe you've been trying to figure out trading for 2 years, stop trading. Invest 30 days, 60 days, learn something that's, it's a really cool trade and it's something that you can really grow into. And that's something that I really like about it. A lot of these different trades, once you learn, you kind of figure out the whole darn thing. There's not much more to grow into. This trade, it's a big boy trade. Okay. So I think that's about it. If you guys have any more questions for me, you could always just email me at support@activedaytrader. Again, I'm going to be a quick reply. And I think you got Patrick's contact information. And then I'm sure they'll send out the recording sometime tomorrow. Hey, Deb. What's up, Leo? Patrick, thanks a lot for having me. I really appreciate it.
Yeah, for sure. No, thanks, Jonathan, for coming. I appreciate it as well. I want to show a couple people the charts. If you don't mind if I take the screen back for a minute?
No, please do.
Okay. So basically, folks, what we did was with Jonathan's help, I put together a bunch of these pre-made chart books. So for those of you who are familiar with Sierra, we call these files chart books. So I just titled them in a way where it's easy to know what's what. So we have like the 1 ZB minus 1 UB. So there's the UB up here, and these are in SEP because we had the rollover. So there's the UB, there's the ZB, and there's one minus the other displayed as the main price graph. So we just basically did this using a different study that exists within Sierra, and we just do one chart minus the other, and then we just formatted it, with a color scheme, and this is how it looks. So like this here is the 3ZN minus 1 ZB. So it's really easy in Sierra to use multipliers. So if you want to do a knob spread like this, you have 3 times the ZB minus 1 times three times the ZN minus 1 times the ZB, and then it yields this value. Jonathan put together this gold-silver ratio a while ago. A lot of people do trade spreads in other markets as well, or they look for relative value ideas by valuing one market or the other against the other, like Jonathan says. So this is gold and silver. We put together a file here that has a bunch of the spreads inside of one screen. So you've got like 5 ZF against 3 ZN. You've got 6 ZT against 1 ZB. You've got 2 ZT against 1 ZN, et cetera. So you could do this on your own, and certainly as a customer, you will probably at some point want to learn how to do this, but it is kind of nice to have something that sort of works right out of the box. So if you are either a customer or a demo user of our software and you want us to send this to you, just email your rep in our office, and you may not know who it is yet. Some of you might be new to our system. You just reply back to any email you get from Infinity, and that will get you to the right person, because odds are it's being sent directly from your representative in our office, and we'll make sure to get the files to you so you can import them and start using them in the demo environment. So this stuff would carry over into the live side. There was a question earlier about the minimum. Jonathan answered. It's $3,000 for a new account. So we have a lot of flexibility from a margin perspective, both with outrights and, as Jonathan has obviously said, with spreads. So, if you want to dip your toe in the water, you don't have to send over a ton of capital. The margin on the ZB UB contract spread is something like $1,500 or so. I think the knob spread is slightly less than that. I mean, these contracts have low enough margins where you can start trading them usually with relatively modest balance if you just want to give it a try without putting a ton of money at risk at first. All right, so lots of flexibility. You're working with a company who doesn't treat this as a side project. It's the only thing we do. We can communicate at a high level and speak objectively when it comes to risk, and try to help you stay out of the common pitfalls and give you someone you can pick up the phone and talk to when you need to. It's a little bit of a different relationship than what most people expect out of a discount firm. At least that's what we would argue. So thank you for listening. I do appreciate it. Jonathan, as always, thanks again for your time today coming to the event. Let's get another one on the calendar, and let's get some YouTube videos going again. I haven't seen one from you in a while, but those accumulate a lot of hits, and we do get a lot of feedback on them. So we do appreciate everybody's contribution and your time today. And Jonathan, thanks again, sir, for coming to
Thanks, Patrick. I appreciate it.
All right, folks. I will get the recording up within a day or so. You'll get an email about it. It'll be up on YouTube. Please come back to us with questions. Let us know how we can help you. If you have any, small groups of traders or friends or anybody you'd like us to present to, or do a small group training session or something like that, we're open to that as well. We do it all the time, and we're always looking for feedback and ways to improve our firm. So thanks again. I'm going to read some risk stuff. We'll shut the room down, and we'll see you next time. All right? All right, everybody. Thank you. Trading futures, options on futures, and retail off-exchange foreign currency transactions involve substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. All right, everybody. See you next time. Thank you.